Enron's $70 billion collapse stemmed from a decade of incremental accounting choices. The company meticulously decoupled its reported paper revenue from the actual cash generated by its physical operations. The company began with a traditional physical foundation. Formed in 1985 through the merger of Houston Natural Gas and Internorth, Enron was an asset-heavy regional utility company controlling over 36,000 miles of physical natural gas pipeline across North America. Under the leadership of CEO Kenneth Lay, the company aggressively lobbied the federal government to deregulate natural gas markets. Lay's push was successful, legally unchaining Enron from regulated utility rates and allowing the company to sell energy at fluctuating market prices. To capitalize on this newly deregulated landscape, Lay hired Jeffrey Skilling, a former McKinsey consultant, who proposed the creation of a gas bank, an intermediary institution that would sit directly between gas producers and consumers. Skilling implemented a merchant model. Natural gas was no longer treated simply as a physical utility requiring extraction and delivery. Instead, it was packaged as a financial derivative, a tradable contract whose value is based on the underlying price of the gas. The financial impact was immediate. By fixing selling prices through long-term contracts and charging a premium for the service, Enron earned $122 million in trading profits by 1992. It rapidly became the second-largest contributor to the company's net income. This regulatory shift reoriented Enron's business model. The company's focus moved from maintaining physical infrastructure to generating profits through aggressive financial engineering. Trading complex, long-term derivatives required a different set of financial mechanics. Enron's existing accounting framework was insufficient to track the volume of contracts it was signing. This chart compares traditional accounting to mark-to-market, or MTM. MTM is an accounting method that allows a company to estimate the fair value of a long-term contract and record the entire projected future profit as current income on the day the contract is signed. In 1992, the U.S. Securities and Exchange Commission granted Enron a unilateral privilege to apply MTM valuation to its energy contracts. They permitted this even though viable, liquid markets to accurately price those long-term contracts did not yet exist, creating a massive gap between reported profits and actual cash. Enron's accounting department exploited this subjectivity by applying excessively optimistic assumptions to calculate the present value of future cash flows. They booked highly speculative and uncertain future revenues as definite, current-year income. In 2000, Enron entered into a 20-year agreement with Blockbuster Video to provide broadband video-on-demand services. Despite the fact that the underlying technology was completely unproven and the partnership collapsed within months, Enron used MTM to record $110 million in anticipated profits from the deal. This created a revenue treadmill. Because Enron had already claimed the future profits of its existing contracts, it generated zero new paper growth. To satisfy Wall Street expectations, Enron was mathematically forced to sign increasingly larger deals every quarter just to offset the lack of real cash from previous MTM bookings. Mark-to-market accounting manufactured an illusion of hypergrowth. It allowed Enron to continually report record-breaking quarterly earnings while simultaneously masking a severe terminal deficit in operational cash flow. Beyond simply inflating its future profits, Enron also manipulated the sheer size of its top-line revenue through its trade reporting practices. Standard trading firms operated on an agent model, acting as brokers between buyers and sellers. Enron designated itself under a merchant model. The math is entirely different. Under the agent model, traditional firms reported only the small brokerage fee they collected as revenue. Under the merchant model, Enron reported the entire gross value of every single energy trade as its own revenue. This accounting choice pushed Enron to report $138.7 billion in revenues for the first 9 months of 2001. It secured Enron's rank as the 7th largest corporation in the United States. Reporting gross revenue mathematically disguised the company's underlying insolvency. It produced top-line figures so spectacular that market analysts replaced standard due diligence with uncritical awe. As Enron's aggressive expansion into international power projects and broadband began to fail, the company faced a debt crisis. CFO Andrew Fastow was mandated to keep these non-performing liabilities off Enron's balance sheet to protect its investment-grade credit rating. Fastow utilized special purpose entities, or SPEs. An SPE is a legal corporate structure created to fulfill a narrow objective, typically used by companies to isolate financial risk from the parent corporation. Under the generally accepted accounting principles of the 1990s, Fastow exploited a specific loophole, the 3% rule. This rule dictated that a company could avoid consolidating an SPE's debt onto its own books if an independent third party contributed just 3% of the capital and maintained control of the entity. In 1997, Enron needed to buy out its partner, the California Public Employees Retirement System, from a 1993 joint venture called JEDI. Doing so directly would force Enron to absorb $600 million in debt. Fastow's solution was to create Chuco, an SPE designed to act as the independent 3% capital stake for JEDI. But the structure was a mechanical fraud. The funding was a $240 million loan from Barclays Bank, secretly guaranteed by Enron itself. The arrangement committed a second violation. Chuco was managed by Michael Copper, an Enron employee, destroying the legal requirement of independent third-party control. Through the systematic abuse of the 3% rule across dozens of SPEs, Enron maintained a high credit rating while secretly accumulating non-performing liabilities. In 2000, Enron created the Raptors, a complex series of 4 SPEs specifically engineered to shield the company from mark-to-market losses on its volatile equity investments. The hedging mechanism worked like this. Enron transferred its own stock to a Raptor. In exchange, the Raptor issued a derivative contract promising to cover any Enron losses. But the structural flaw was circularity. The Raptors were capitalized entirely by Enron's own stock. The hedge functioned exactly until Enron's share price began to drop from its peak of $90.75 in 2001. As the stock fell, the Raptors lost the financial assets they needed to fulfill their payout obligations to Enron. In a desperate attempt to keep the Raptor entity solvent, Enron issued millions of new shares. This flooded the market, diluted the stock further, and accelerated the downward spiral of the share price. Capitalizing a hedge with your own company stock is mathematically suicidal. It guarantees a total corporate collapse the moment market confidence wavers. The accounting department's deception was mirrored by Enron's internal corporate culture. Skilling implemented the Performance Review Committee, an evaluation system known as Rank and Yank. Under Rank and Yank, employees were graded on a bell curve every 6 months, and the bottom 15% were routinely fired. This created a hyper-competitive environment that rewarded immediate profit extraction and punished employees for reporting operational problems. This predatory culture found its target during the 2000 to 2001 California energy crisis, as Enron traders sought to exploit the state's deregulated electricity markets. Traders deployed illicit strategies with colorful names. The Death Star strategy involved scheduling phantom energy to move in a meaningless circular loop across the grid. No actual energy was delivered, but Enron collected state congestion relief payments for appearing to solve grid bottlenecks. The Ricochet strategy involved exporting cheap California power out of state to an Oregon utility and then immediately re-importing it back into California to bypass in-state price caps. Through the Fat Boy strategy, Enron intentionally overscheduled the power it intended to deliver. When the state's grid operator inevitably demanded more power, Enron would discover its excess supply and sell it back to the state at astronomical spot market prices. Energy prices in California spiked by a factor of 20. The state was forced to implement rolling blackouts, while audio tapes later revealed Enron traders laughing about stealing money from consumers and crushing the economy. Enron's operational strategy had degraded into institutionalized extortion. The company moved from complex trading to a deliberate, predatory exploitation of the energy grid. In August 2001, Jeffrey Skilling abruptly resigned after only 6 months as CEO. Days later, Vice President Sharon Watkins sent an anonymous memo to Ken Lay, warning that the company might implode in a wave of accounting scandals. The catalyst occurred on October 16, 2001. Enron released an earnings report revealing its first quarterly loss in years and a $1.2 billion reduction in shareholder equity tied directly to Fastow's SPE partnerships. The discovery of the secret side deals forced a retroactive consolidation of Chuco onto Enron's balance sheet. This wiped out $400 million in previously reported profits, added $2.5 billion in hidden debt, and triggered an immediate credit downgrade to junk status.
Enron's external gatekeepers failed. Arthur Andersen served as Enron's auditor, but its independence was compromised by $27 million in concurrent consulting fees paid by Enron. When the scandal broke, Andersen employees in Houston began a systematic effort to shred thousands of documents and delete emails. This act of obstruction led to a criminal conviction that collapsed the 85,000-employee accounting firm. Major Wall Street institutions, including Citigroup and J.P. Morgan, were also involved. They executed complex prepay swaps, triangular deals involving shell corporations, to disguise billions of dollars in bank loans as normal operational trading revenue. The fraud persisted for a decade because the professional oversight ecosystem designed to protect the market was financially incentivized to look away. Enron filed for Chapter 11 bankruptcy on December 2, 2001. Over 4,000 employees lost their jobs immediately. Because the company locked down its retirement plans during the crash, employees watched helplessly as their 401k accounts evaporated, while the stock plummeted from $90 to less than $1. In response to the devastation, Congress passed the Sarbanes-Oxley Act in July 2002. SOX is a piece of federal legislation designed to mandate strict new rules for corporate disclosures and restore public confidence. SOX established rigorous auditor independence provisions. Accounting firms are now strictly prohibited from providing non-audit consulting services to the clients they are auditing. Section 302 of the Act mandated executive responsibility. CEOs and CFOs must now personally sign and certify the accuracy of their company's financial reports, carrying a penalty of up to 20 years in federal prison for knowingly signing false documents. A Department of Justice task force secured 22 convictions, including felony convictions for Jeffrey Skilling and Andrew Fastow for conspiracy, securities fraud, and insider trading. Mark-to-market accounting and special purpose entities can manipulate earnings and hide debt on paper, but they can never manufacture actual cash. The Enron collapse proves that overwhelming complexity is often just a cloak for insolvency.